Good afternoon, everybody. This is Scott Vance with Trishley Financial Advising. Today, I'm going to talk a little bit about college funding. We're going to go across about 10 minutes and just go through a whole list of different topics regarding to college funding. If you ever need help with college funding, both before planning for your child to go to college and after dealing with student debt, you can certainly contact me at trishleyfinancialadvising.com, and I'll provide a link in the notes. So just to get started, today college costs approximately, well, for state colleges, generally the price right now is about $19,500 a year. Private colleges and universities, naturally those expenses are a lot more. The total average for a private college and university is at about $43,900 a year. This price includes tuition fees and also room and board. So one of the first things you can do to save a little bit of money if you want to go to one of these schools is possibly staying at home, thereby reducing the room and board fee, possibly by having the student stay at home. But one thing to understand is that these are sticker prices. So just like a car, the actual price you pay is going to be less than that. College costs continue to outstrip inflation. But like I said, most families don't pay the full cost for a college education. About 58% of students receive scholarships and grants. And then the amount that you actually pay for the college, or for the experience of a year of college, private institutions, which obviously are the more expensive choice, only about 11% of the students pay the full price. So again, I'm Scott Vance, Trishley Financial Advising, and my specialty is working with college costs, both before planning for college and on the backside, planning for the student loan debt that you have to pay for. So we'll get into the question of to whether your child will qualify for financial aid. The first step, obviously, is to save as much as you can. Hopefully, you've started early. Every dollar you save is a dollar less you have to either finance or get a loan for, or get a grant or scholarship, or actually pay for. While, of course, saving for college should be a high priority for parents, I wouldn't forego that for retirement. You always need to remember that college you can get a loan for, but you will never be able to get a loan for your retirement. I would suggest that if you're planning to save for college, that as much as possible, you do it within 529 plans, which provide for tax-free withdrawals when you use them for qualified college expenses. And they're very broad as to what they consider college expenses. And then the other good thing about 529 plans is it's a very easy way to save for college. You just open an account, you put it on autopilot, and each month automatically contribute a certain amount and save. Another way to save as well is a Coverdell ESA, or education savings account. The Coverdell is less preferred in that the annual limit you can contribute is rather low. It's about $2,500 a year. The 529, you can generally contribute. Each state has its own max contribution, but they generally use 4 years of a college cost as the max contributions to a 529. The one advantage of a Coverdell ESA is you can withdraw money for your child to attend like paid high school. So it's not only for college as opposed to the 529. Excuse me. So as you look at paying for college, where do the sources of funding come from? And I'm going to read a couple statistics to you. So generally, across the board, and this is from the College Board, which provides trends in higher education costs and expenses. So approximately 40% of average student 40% of the cost of college is covered by the federal government for an average student. About 35% for an average college student is covered by the college themselves. You can expect about 11% to come from state government, grants, loans, or excuse me, not loans, but money. And then the two smaller numbers are private scholarships, generally about 7%, and employer type incentives. You can expect about 6%. So some of the funding that comes from the federal government, the big one is the Pell Grant. It's by far the largest federal award program. This year, it's a maximum that can be awarded under the Pell Grant is $5,775. However, it is somewhat need-based, so most grant recipients that receive the largest amount have household incomes of less than $40,000 a year. And then the Federal Supplemental Education Opportunity Grant, or FSEOG. First of all, before you can be considered for the FSEOG, you have to be eligible for the Pell Grant. And the FSEOG can range anywhere from $100 up to $4,000 a year. This money is designated by campus, by school. So depending on how many people you have at the school that would be eligible for this, it can affect the amount that you're going to get. So this is where you get into filing your FAFSA for your financial aid, which you want to do as soon as you possibly can, which will be October 1st of this year. And then each state, which I'm not just going to talk about this broadly, almost every state has a state aid agency with a grant or scholarship program. Again, and this is dependent upon the state. Some of them are based on need, on financial need, and others it's based on merit. And then usually, again, these are the eligibility based for these events are usually required to be a resident of that state. And if you're interested, you can contact me at www.trishleyfinancialadvising.com. And there is a link that will get you to your particular state education opportunities. Next, we'll talk a little bit about college grants and scholarships. Public and private colleges provide students with need-based financial aid. They also provide scholarships based on merit. So the merit scholarship would be for being super smart or whatever the particular scholarship is, and then the need-based financial aid would be dependent upon the student's financial need. For most students, the amount of money awarded by the state, by the college, represents the largest source of money. And then just so you're tracking, just an idea, the average discount that a private university or institution gives to an average student, the tuition discount is about 54%. So you're talking a tuition discount of about a half. And this is a figure that comes from the latest survey, so that'd be 2015, by the National Association of College and University Business Officer. And this is actually at an historic high. So you can see that the need is increasing. I know a lot of people talk about athletic scholarships. Athletic scholarships can be super, but they are not nearly as lucrative or plentiful as people would think or want. They say about 2% of graduating high school seniors that are athletes, they win a sports scholarship every year. And that's everything from a couple $100 for books all the way up to the full rides. So there are 6 sports in the NCAA which provide for full ride scholarships. These are the big ones that everybody thinks of. They call them head count sports, and basically that limits the amount of scholarships that the schools can provide. And the deal with the head count sports is that scholarship is a full ride or nothing at all. So here's the 6 sports that are the head count sports that provide the full ride scholarships or nothing at all. So in men's sports, you have football, which provides 85 full ride scholarships. Basketball, which provides 13 full ride scholarships. And for women's sports, you have basketball, which provides 15 scholarships. Tennis, which provides 8 scholarships. Gymnastics, which provides 12 scholarships. And volleyball, which provides 12 scholarships. So these sports are generally they're found within Division I schools. So your Division 2 and 3 have other rules, but for Division I sports, if you're talking a full ride scholarship, that's the total amount that you can get. So imagine 85 football scholarships across every Division I school. And to think that those 85 are full rides, but there's nothing less. So there's no half rides, no quarter rides at the Division I level. Division II is allowed to provide scholarships that are less than full rides. And Division III schools generally don't give athletic scholarships, but they do provide financial aid and merit scholarships. They can favorite those two athletes. If you have a question about athletic scholarship resources, I can provide you the links to get to those. There's the NCAA as well as scholarship stats. You can contact me, Scott Vance, at Scott, SCOTT, Vance, VANCE, at Trisuli, TRISULI, financialadvising.com, to answer your questions. So the next thing that comes up is private scholarships. Private scholarships come from things such as charities, benevolent organizations, civics groups, and companies. Generally, private scholarships represent the smallest amount of funding for schools. The average private scholarship is about $4,000, and most only last for that 1 year. For the bigger national scholarships that provide a lot more money, that's very competitive. And generally, if you focus on local scholarships or scholarships that are somewhat of a niche, the student's chances of getting some kind of an award are very much elevated. And for those local niche scholarships, I would talk with your student's high school counselor and library. I wouldn't pay for service. I would do my own research and use that action. So financial aid. As you begin your search for college money, you need to answer these important questions. Will your child qualify for financial aid? A lot of parents spend many, many nights awake wondering about this question. And it's not an easy answer because of the various factors in the way that they compute the financial aid. So basically, on the line, the first thing you need to be aware of is this thing called the EFC, or Expected Family Contribution. Expected Family Contribution is what is expected to come from the family to pay for the school. And this number depends largely on income, family size, so marital status, but it does not include generally the value of your primary home, your retirement assets, so 401k, 403s, annuities, IRAs, but it would include like a second vacation home, or if you have a lot of money just in a regular old investing account that is not under any protection. So just an example for some numbers. So say a cost of an in-state public university is expected to cost $22,000 a year. So if your family's expected family contribution, or EFC, would be $35,000 a year, and that would again go back to the factors of income from the parents, assets on the parents, assets of the child as well. So that would tell you, since your EFC is higher at $35,000 than the cost of the public university, $22,000, you would have very little chance at need-based aid, because you can pay for what the school costs. However, if you would look at a private college, which costs about $60,000 a year, and then you take from that your EFC, which is $35,000, you would have a financial need of about $25,000. Whether your child would receive this amount in scholarships or in price cuts by the college depends on the college, the individual college's generosity. This demonstrated need of $25,000 could be made up of loans. So how do you obtain your expected family contributions? If you go to the College Board, which is www.collegeboard.org, and look for their EFC calculator, you can go ahead and put in your relevant information, and it'll feed you out what you could expect your expected family contribution to be. I would suggest that you do this early on, even at the middle school years for your child, just to get an idea of what you're looking at in the future, and then update as you get closer to the child actually attending college. So earlier when I talked about the EFC, I talked about the cost of the college. So how do you go about finding out what the actual cost of that college is? Well, in the old days, like when I went to school, there was really no way to figure out the exact cost. But now, in recent years, the colleges are being required to provide a net price calculator. So if you go to the college's individual website and you look for their net price calculator, and I'm sure there's probably other names, but if you would come up and you can't find it, please contact me, Scott.Vance at TrishleyFinancialAdvising.com. I would help you find that net price calculator, and from that'll give you a good estimated. It depends too. Some of the calculators are not as trustworthy as others. There should be, since the cost of the college is just like figuring out your expected family contributions. There's numerous factors. So if the calculator just asks you a couple quick questions and just spits out a number, I would be somewhat suspect of that number. But if it has a lot of detailed questions, that probably is a much more realistic estimate of what the college will cost. So talking about financial aid, to qualify for financial aid, the first step obviously is to apply with the free application for federal student aid. Every college and all financial aid is required to use the FAFSA. Excuse me. You can go to the federal government website to get the link to that, to start that. This year in 2016, these applications will be allowed to start being filled out as on October the 1st. Previously, you used to have to wait till January to fill them out, and then your child would be graduating that spring, and they would be off to college either that summer or that fall. So they've pushed the availability of these forms back to October the 1st. That being said, it pushes your base year back, which your base year is your tax year that is used to figure your FAFSA aid EFC. So your child, your tax year would be the year that your child would be a sophomore, or excuse me, in the spring would be a sophomore, then it would be a junior, a fall of their junior year. So basically 2 years prior. There is also an additional form that may be required. In addition to the FAFSA, there's this thing called the CSS Financial Aid Profile. This form is owned by the College Board. This is used by about 230 colleges, generally private, smaller universities. And their computation is a little bit different, and that they include some things that the FAFSA does not. These schools are required still to use the FAFSA, and then they just use the CSS Financial Aid Profile on top of the FAFSA. So you'd have to fill out the two forms for these universities. So how do some of your investments impact your financial aid? So just so you're tracking FAFSA, the aid formula, which comes to your EFCU, or expected family contribution, ignores your primary home equity. Retirement accounts, 401s, SEP IRAs, Roths, Qs, 403s. It ignores annuities. And then also ignores life insurance cash value. Schools that use the CSS profile, the aid profile that the College Board owns, generally ignore retirement accounts, qualified annuities, and life insurance cash value. So you can see the difference there. They generally include primary home equity. And then both the FAFSA and the profile consider these assets available for funding college. So parents and child non-retirement accounts, that includes checking, savings, and brokerage accounts. They include 529 college accounts, and then also custodial accounts. So how does the FAFSA generate this EFC, expected family contributions? So basically what it does is the FAFSA takes the parent's assets, and in general the FAFSA considers that the parent's assets the parent can be expected to contribute up to 5.6% of their assets for their child's college education. But students are expected to contribute up to 20% of their assets. So you can see the value in the student not having ownership of the assets. Given a choice of a parent being the owner of an asset or a child, is probably better from a financial aid standpoint to have the parents be the owner of those assets. A couple other things that are probably worthwhile. The grandparents generally want to be careful in how they help contribute to the student's college education. So if financial aid is at stake, so if you're looking for a lot of money, you kind of want to have the grandparents wait until after financial aid to the FAFSA is a factor, which generally is going to be about the junior year of the student. So because if the grandparents contribute assets towards that student's education, generally they're rolled up as assets of that child, so at a 20% rate. If you have a 529 plan, grandparents could contribute to that 529 plan, because that's considered that contribution is not considered an asset of the child. So just be careful with grandparent contributions. There's a lot of trickiness that gets into this, and it could actually end up costing the child in financial aid. one of the things talked about is graduation rates. I was kind of shocked to find out that state colleges and universities, in general, that graduation rate is 33% within 4 years. So this is graduating within 4 years. And then private colleges and universities are about 53%. So as you consider the cost of college, a good way to reduce the costs is to ensure that you graduate in 4 years. If you look at, if you contact me, Scott.Vance at TrishleyFinancialAdvising.com, there's links that I can provide that will give you the average college completion rate. It'll break those graduation rates down by race, ethnicity, gender, and then also by major. And then there's a further link that I can get to you that would give you the expected first year salary of a student from X college with X major, what the average is. So again, and then I would suggest also, as you're looking at colleges, take a much wider look. College Scorecard is a website to take a look at. This will give you access to, so the website is https collegescorecard.ed.gov, and that gets you to all the database of the Department of Education's information about schools and majors and things like that. Another great website is College Board, so www.collegeboard.org. And there you can figure out the generosity of the school, so it'll give you a percentage. So it'll say, hey, 75% of the students receive an average of $3,000 student aid from the school. And then there's a University, which is a LinkedIn site. So linkedin.com/.edu. And this provides just a whole bunch of tools for the students to look at various colleges. So then we get to the 500-pound gorilla, which is the borrowing. As you may or may not know, the borrowing for student education has become detrimental to recent graduates, and their ability to pay that is seriously impacting their ability to move out and start their own life. So today, about 71% of students get college loans to pay for college. And then in 2015, the average student left college with $35,000 in student loans. Those student loans can be federal, subsidized, unsubsidized, as well as private loans, which are not subsidized. In general, you want to stick with federal loans, federal student loans, both subsidized and unsubsidized. And here's the reasons why. Generally, students, regardless of their income, qualify if they're at least half-time enrolled in school. The interest rates on federal loans do not adjust based on the student's credit rating. It's basically a set interest rate. The loans, federal student loans, can be repaid based on the salary, after graduation of that student, and those repayment terms can be extended to make up for a short salary. And also federal loans become available for loan forgiveness in certain circumstances. And then you can borrow for federal loans for undergraduates, graduates, and also parents of undergrads, so the PLUS loan. So just an idea on the interest rate. So a direct subsidized student loan for an undergraduate right now are running at about 4.29%. A PLUS loan for parents, which is a direct plus loan, which is a federal plus loan. And that's also for graduates or professional students. You're looking at about 6.84%. So, but there are some limits for undergrads. So for undergrads, their first year, in general, an undergrad will generally be allowed to borrow up to $5,500. The second year, that number goes to $6,500. Then the third and fourth years, it goes to $7,500. So if you need to borrow more than that, the student has to go to private loans or to a parent plus loans. And then there's a cap should that child extend beyond 4 years to obtain their undergrad. The federal loans will allow that student to borrow up to $31,000 total. For parent loans, the underwriting is fairly minimal for the federal loans. And generally the limit on those federal loans are rather high. They also allow the parent to pay for costs that don't necessarily aren't covered by a child's financial aid package. So if the child needs a car or gas money or something like that, that also can be paid for. And then the last thing is the tax credits for college. For some of you may or may not know, there's some tax credits that go along with being in school. The first is the American Opportunity Tax Credit. So basically, eligible parents can receive a maximum of $2,500 tax credit for each child in school or college. Basically, the way it works is the taxpayer can claim 100% of the first $2,000 they spend on college as a credit, and then they can claim the next 25% of the next $2,000 for college. And the costs that are applicable to this credit are tuition and fees, course materials, textbook supplies, and equipment. Now, room and board do not count for the American Opportunity Credit. If the child should go beyond 4 years of school, you can then claim the lifetime learning credit, which basically is a $2,000 credit, but it's broken out as 20% of the first $10,000 in expenses. So if you pay $10,000 in student loan expenses, you can recover $2,000 of that on the credit. And also be aware that there are some limitations on these credits. For instance, for the American Opportunity Tax Credit, the family's modified adjusted gross income must be $80,000 or less for a parent filing as a single taxpayer, or $160,000 if married filing jointly. And then finally, with these tax credits, as well as all the other options out there, you can't do double dipping. So if you pay for certain costs with your 529 plan, that cost is removed from the computation for your tax credits. So if you pay $10,000 of 529, and that's how much all school costs you that year, you can't then also go in and claim the $2,500 American Opportunity Tax Credit for that $10,000. You effectively zeroed it out. So I just gave you a quick overview of some of the financial aid specifics you can expect as you're getting ready for college. You can contact me for more information at scott.vance@trishleyfinancialadvising.com, or come to my website, which is trishleyfinancialadvising.com. And then also I'll be running webinars if you're interested. Please sign up. And if you have any questions, feel free to email me. And if you have any questions, let me know. Have a good day. Bye.